Hello my fellow freedom builders and welcome back to the channel. Today's video is about sectors. I've made videos about that before explaining it, but I have some new tools for you that I'm going to show you. So if you stick to the end of the video, I think you'll be a lot wiser as to what sectors we should be looking at, how to evaluate which sectors are coming up soon, and overall just investing more confidently. Now, when we're looking at sectors, you might remember, if you have seen one of my former videos, that there are several different sectors and they are moving some sort of in conjunction with the overall economy. However, as you might have noticed, for instance, last year, it does not necessarily have to be in a way where the economy and the stock market is aligned. You could say that sometimes the stock market is in front of the overall economy, or at least it is not really running in tandem with it. What we can see here is we have the red and the green curve here, the graph, and the green is the overall economy. It can be in full recession, everything is going down. We have the early recovery, so that things start to lighten up a bit for people getting jobs and so on. We have the full recovery coming in here. We have the early recession, and then it goes again. It does not necessarily have to be in a way where the full recession is the same length as this part or something like that. This is just a graphical representation, so it can go very quickly all over the cycle here in 6 months, or it can take a couple of years. So there's not really anything steady here. Then we have the red graph, and that is the stock market. And as you can see, the stock market starts to bottom out before the overall economy. And that is because people are starting to anticipate what sort of stocks might come in favor in the market when the market bottoms out. And then we start to move into a real good bull market here. The economy is following, but the market participants can see that the market might be a bit too hot, so they start to anticipate what to go into next, and then the stock market turns and the economy turns. And then we continues over and over and over again. Now, these are the basic sectors, and these are very broad sectors, but let me just give you a quick glance into what is in them, because of course we have the technology, kind of says itself what that is. We have the cyclicals. Now, cyclicals are also called the discretionaries. And what this is this is a product that is not necessary for the consumer. We can go into the website here. I can just show you here. This is the stock charts website, and as you can see here, we have technology, we have discretionary here. So discretionary is something that the consumers buy that is not vital for their health or their livelihood or something like that. So these are products that are nice to have and not need to have. We can just stay on this here. We have the communication services. We have the industrials, meaning the production of things. We have materials, that is all into mining. That could be gold, silver, palladium, platinum, copper, whatever, steel. We have the energy, of course, mostly oil and so on. We have the consumer staples, and that is the one, if we just go back to my slide here, this is called the staples here, but they normally are often called the defensives as well. And that is because here we're talking about products that the consumers will buy pretty much no matter what sort of recession we are in, because they are just almost need to have on a day-to-day basis, or at least products that does not take up too much of the day-to-day economy of the consumer. Then we have healthcare. Of course, even though we are in a deep recession, healthcare will still be a thing. People will still need their medicals, drugs and so on. The same with utilities, the water, the electricity. It should be a really, really bad recession before we don't need the utilities. Then we have the financials, the real estate here, and then we go all over again. Now, what I'm going to show you today is a tool that I have been using lately, and I am in the stock charts, and I must admit I'm not even certain if this is only in the paid version, but I think it is open to everybody. Here in stock charts you have this performance chart, and let me just take this up a bit here. What we can see down here is that I have put in all the S&P sector ETFs, meaning that each of these is an ETF covering an entire sector, and you can see them XLY, XLC, XLK, and so on. They are matching these sectors down here. We have the discretionary, communication, service, technologies, industrials, and so on, all the way here. So these are matching what we see here. What we are seeing here is how well they have performed over a given period. And what I have taken here is 60 days. That is approximately a quarter. It could be 65 days. Some are using over the last 30 days and so on. But I've chosen a quarter here. And what we can see here is quite exciting, because our three main sectors right now is industrial, materials, and energy. And that tells us that we have industrials, materials, and energy, which are very, very good stocks to be in right now. It also tells us that we are somewhere in the early recovery, moving towards full recovery. So it is going well with the economy, at least for a while ahead now. What we can see here is that when we are moving this slider, let me just make it so you can see it here. When I'm moving this slider, of course the bars will get somewhat different, and I want to show you some cool examples here. Let me just scroll this back to 2018. If you recall, we had quite a big crash, I think you can call it, in the stock market in 2018. Let's just have a look at here. I know it doesn't seem like much here, but those of us that were in the market, we felt it. We had from the top to the bottom down here. We had, here we had quite a drop in the S&P 500 here. Sorry, I'm at the wrong place. That's why it seems wrong. We were at almost 20% drop. My mistake. And this drop felt quite severe when we were in it, and it actually resulted in a lot of funds. They actually had a good 2018, but this last quarter of 2018 destroyed their entire performance for the year. Now, could we have seen this coming? And I'll say straight up, no, we could not. I'm not in the fortune teller business. But it is funny to look at these sectors to see what they actually told us. Because what we were seeing here in late August, early September was a very clear picture that the staples, the healthcare, and the utilities were leading everything here. And that should tell us that we were in the consumer staples, the defensive, we were in healthcare and utilities, meaning we were at the end of the economic cycle, and we should actually be somewhere heading into a market top. Now that is very interesting. Another thing we can look at here is what kind of characteristics are in the full recession, early recovery, and so on. And what we can see is that, for instance, the consumer expectations, I have different websites we can watch them on. Industrial production, and we could actually see that leading up through 2018. I know that there was a political environment in the United States wanting to communicate something else, but actually the GDP growth was starting to disappear. So we were moving into into at least a flat industrial production. Now the interest rates, and here we're talking about Fed's interest rates, they were actually going up. They had started to move the interest rate up, and that is one of the reasons why we had the crash in the market. The yield curve, I'll not go into that now. I have made videos about that before, but it's a bit complex. So basically, we could see that we ought to be just around a market top. Now, I didn't predict, and I guess nobody really did, predict that the exact market top would be here. I have my trend following strategies and they sent me out in good time here. But it's just funny to see that this crash here, this start of a bull market, were actually almost predicted with the sector rotation. Now, if you recall, just here in the Christmas days of 2018, Fed went out saying, "Now, well, we might have been a bit too hasty with the interest hikes, so we will definitely do something about that in 2019," and everything went up. Now, let's have a look at the sectors here to see, and you can follow here. This is the end date. Here you can see we have through October, we had into December here. We started to move this way here. And in the beginning of the year, we could see, boom, January, February, discretionary, communication service technologies, starting also on the industrials, showed us that now we were in a bull market. We should just invest all that we could into this market. And so the sectors flow, and you can see just slowly. It is just, they can jump back and forth, and we should not look at just a single day, but more of an overall picture here. When we see we are moving into 19 here, we can see that slowly the discretionaries are starting to drop. We can see technology, as you know, 2019 was a fantastic year for technology, and that one of the reasons was all of the virus environment, and that has actually skewed a lot of the sectors right now with all the stimulus packages and so on. But here, moving into, we have January 2020 here. We can see technology is still big, and then something happens. We can still see here. Then we are moving into July. We are starting to move to industrials, materials. Now, if you recall, energy was still very low, and that was due to the COVID situation where people could not fly, they could not go anywhere, they were pretty much locked down. So that should be taken into consideration here. So we are moving, we are starting to see a shift towards materials, energy. And where are we now? We can see the energy is really booming. This is the beginning of 2021. And this is, of course, because things start to open up after the entire shutdown in the economy. So where are we now? Well, we are at a place where, as I said, the industrials, materials and energy are high. Then we have the financials shooting up as well. And that is due to an expected rise in interest rates, so this can also skew things. Again, we should not take this as a fix-all indicator, and we can see that the financials are, the banks, the major banks are really running hot right now, and that is because a higher interest rate will make it so that the banks have an easier time making money. But what we do see, if you look at the stables, healthcare and utilities here, is that they have gone from negative territory up towards a positive territory, indicating that we are slowly moving into this area where we might see a market top. Now, it does not have to be a market top where we see a 20% drop, not at all. It can be some sort of correction, and it's not even certain that we see that, because right now we do have a ton of stimulus running into the market, and that actually might be able to make this correction, some sort of in the market, go away at least partially, but it will come eventually, of course. So what our sector indicator here is telling us is that we are moving into this area, and no matter if we are seeing a retracement in the market, some sort of correction, it can be a good thing to consider the consumer staples, the healthcare and the utilities in the coming time, since it seems like they are the new hot stocks. Now, if I'm correct here, and it doesn't have to be that way, these are just some tendencies I'm looking at, but if I am correct, it does not look too good for the future of these hyped tech stocks that we saw last year, because many of them are definitely not in the consumer staple area. They are more in the technology, communication service and discretionary area. And that is not really where we are right now. And I know that some people are arguing that this is just a retracement for them. The entire ARC disruptive industry thing will come back. And yes, it probably will. Nobody knows when, but right now it seems like we are moving into sectors that are not favorable towards these. And including with the rising interest levels, this will also be tough on many of these. Okay, another little gem I'll show you here. I've shown you that in videos before, but that is something called the relative rotational graph. And that is showing something about where momentum is shifting towards. And you can see we have the leading stocks, they are going up and accelerating in momentum. Then we have here, they can still be going up, but the momentum is weakening towards the S&P. Then we're going down here, the stocks are actually dropping here, and when they start to move into this area, they might still be dropping or they might be flat, but they are improving, meaning that the momentum is shifting. And what we can see here is that we have 3 blue of these worms here, and as you can see, we can follow them here. Again, I've made videos about this before, I might make one again, but what you can see here is XLU, XLP, and XLV is the utility, the staples, and the healthcare, so they might be coming into favor soon here. So this is just the relative rotation graph, is something I often look at when I try to evaluate where we are in the overall sector rotation. As you can see here, some of the yellows pointing downwards, losing momentum, is the energy, the financial, and then the communication services make sense here. And we have some real estate, we have some materials and industrials that are still up, but might be slightly turning backwards here. So that is an interesting graph as well. This all fits very nicely with a chart from Fidelity here. And they are showing they're trying to evaluate the different countries in the world, where they are in the sectors in different quarters. And as you can see, China is a bit ahead of us. And then we have the USA and Canada. They are here in the recovery zone. And we have the Eurozone, UK, Japan, Korea, Australia, Brazil, and so on down here. Now, what is interesting is that if we point to a single country like the United States, you can see how they have developed over the last 4 quarters, Q3, Q4, Q1, Q2. So right now we're actually standing still here, still in the recovery zone, moving towards some sort of top. But this is the overall economy. So as you recall, I hope, even though we are here in the economy, it might mean that we are actually tipping over in the overall stock market. Now, I'm not saying you should take all of your money out of the stock market. I'm certainly not. But it is funny to see how these stocks are taking up more and more room in my portfolio because they have started to trend. Now you can see the same here. United Kingdom, Q3, 4, 1, 2. They are still here, not just moving into recovery, and you can take a lot of the countries here to see how they are doing. China moving up towards here. So that is definitely something you could look at as well. I'll put a link to all of this below. Now, what should we do in our investments? Because this is all well and fine, but something you could do is, right now, I have just made a quick screen here in Stockopedia. I'll put a link to that one below, but there are some free screeners as well out there. I'm just looking at United States. I've taken one of my old screeners here. I'm saying I want an interest coverage greater than 10, meaning that if the interest rate is going up right now, I'm not interested in companies that are struggling to pay their interest. I have picked utilities, healthcare, and consumer defensives. We could also go further down into different industry groups that are even lower in the hierarchy here. In healthcare, there are a ton of different industry groups we could look into. But right now, I'm just looking into utilities, healthcare, and consumer defensives. And I have chosen stocks above $5 billion in market cap. It was just some random numbers. It could have been 4 or 10 or whatever. But what it shows me is that I have 98 results here. And we can see the sectors: healthcare, consumer defensive, healthcare, and so on down here. And when we hover over these, we can see the charts. Now it might be a bit off here, but you can see the charts over here, and we might not want stocks that have already gone up too far. So we might go down here. Let's just pick a random stock down here. What do we have? We have PerkinElmer here. Not one I have researched thoroughly, but as you can see, it's a provider of products, services and solutions for the diagnostics, life science and applied markets, so on. So that would be something that would still have a business running, even though the market, the economy at least, should start to tip over. So we could go into that, but we could also have a quick look here at the charts and look at what was it? Was it KPI or just a second? That was the other way around. Here it is, PerkinElmer, and you can see here that yes, it has been in a very nice uptrend here. Then it has had a huge drawdown here of something like 26%, but now it is starting to move upwards again. We are in a yellow zone down here, so I'm not in the kind of trend I would like to be, but it might be one of the stocks that we would like to consider for the upcoming times, and we could take these just one at a time and put them in a watch list in our trading view, and then we could have a look at it once in a while if we think that this is the sectors that will be the winners in the upcoming times. So I hope this makes sense. You can go into stock charts. I'll put a link to that below as well. You can set this up. I put in 60 days here. As you can see, you can decide how many days you want to. And I actually think that there are some predefined groups here. Yes, the S&P sector ETFs, but you can put all sorts of stuff in here, cryptocurrencies and whatever. I've just picked the overall sector groups here. And you can put in 60 days if you want to copy my sector rotation model here. You can make it shorter as well if you put in 30 days. Here you can see that the shift might already be going further this way, industrials moving down. You can even put in 50 days and see that now we can see the stables and healthcare coming in as well. So I'm just picking 60 days. There's no reason to make it overly complicated. This is just to give us an overall view of where are we in the sector rotation right now. And my guess is that we are moving this way. Now, could it move the other way all of a sudden? Yes, there could come something up. Stimulus packages or focus areas in certain governments. It could be interest rates. It could be all sorts of stuff. So this is definitely not cut in stone, not at all. It is just an overall view. I hope this made sense and was some sort of inspirational to you. Remember, this is not financial advice. This is just to make you wiser in building your own financial freedom. Remember to subscribe and all that jazz below, and I'll talk to you again soon. Take care of yourself and your money out there. Bye for now.